So interest rates are high now, really high right now. And there's something we learned along our journey that could help people. What was that?
That we can actually assume mortgages. Okay,
Exactly.
So what does that really mean? So assumable mortgages are government-backed loans, like VA loans, USDA loans, and FHA loans.
Yep.
So let's say you find a house and you really like it, and that house, that the owner had like a 2% interest rate. Now, if that owner has a 2%
Well, hold on. You have to have your real estate agent ask to see
you
if
do have
it's
to ask.
one of those.
Yeah, because you're not going to know.
Because a lot of most loans are conventional, and
Yeah.
conventional loans used to be assumable. They are no longer assumable. And all assumable means is taking over the payment and the terms of the previous owner. That's all it means.
Right. So if that person had one of those government-backed loans, you could take over their payments or their interest rate. So let's say, for example, the house has like $300,000 left on their loan, and they had a 2% interest rate, right? So you're gonna get, if you decide to get that house, you're gonna get that house at a 2% at that $300,000, and then you have to use their bank though.
Right.
You have to get approved by them.
That's
so it can't be just
only downside. You have to use their bank.
You have to use their bank to get approved by. And then any remainder that you owe for whenever you offer, it'll be at the current interest rate.
Right.
So you could save a ton of money, because 2% interest versus, right now it's what, 7% interest. It's a huge deal.
So, for example, let's say you agreed to buy a house for $400,000. The owner has an FHA loan, and the FHA loan has $325,000 left on it, right? You can then say you got approved. And it's a 2%. You can get their $325,000 at 2%. Then you have the remaining $75,000, because remember you bought it for $400,000. You can either come out of pocket with that, which most people can't come out of pocket with $75,000, or you can get a second mortgage on the house, as long as it doesn't go over what you're approved for. So if the bank approved you for $450,000 and you're only at $400,000 because that's what the offer was, then you should be fine. So you take a second mortgage out for the additional $75,000, but that will be at the current interest rate of 7%, if that makes sense. That's just a way that we found to combat the higher interest rates.
Yes.
So always ask your realtor to ask their realtor if the house was purchased with an FHA, VA, or USDA loan, any government-backed loan, because they're all assumable. Now, you do not have, and I heard this a lot of times, you do not have to be a veteran if it's a VA loan. You will still get it. So check that out, and you can save a ton of money.
Yeah, it's true. Yeah, look up assumable mortgages.
Yep.